In this video, I will provide an update on the inflation fight, but it's going to be less about inflation and more about how financial markets reacted to the latest inflation report. One of the things I really enjoy doing is monitoring how asset prices react to new information. And so this Wall Street Journal article really caught my attention. It came out the day that the June inflation report hit the tape, but it only includes price charts for various assets. It doesn't include any explanations. So I thought I'd fill in with my own interpretations. And by doing so, my hope is that I can help to reinforce your own understanding of how market prices react to news. Prices go up and down day to day. They can appear random at times. But in the case of instantaneous price reactions to major news events like the CPI data release, for example, the price movements are generally logical. Allow me to explain using 3 examples showing not only the price reaction, but also the reason for the price reaction. First, let's take a look at the news that moved market prices on July 11th. The Consumer Price Index, or CPI for June, was released that day, and it came in at 3% above the prior year's June. So inflation was 3% over the past year. The estimate before the news release was for the inflation figure to come in a little bit above 3%. So the real story here is that inflation came in softer than expected. The immediate interpretation was captured perfectly in this Bloomberg headline. U.S. inflation broadly cools, likely sealing deal for Fed rate cut. It's the second part of that headline about sealing the deal for a Fed rate cut that is the principal driver here. Since the Fed raised interest rates to slow economic activity in its effort to fight inflation, then a sign that inflation is under control may now mean that the Fed can responsibly lower interest rates. Bonds, gold, and the US dollar reacted very predictably to this elevated probability of lower interest rates. By the way, these are all intraday charts from July 11th, the day of the CPI announcement. And I don't intend to go over the magnitude of the price movements, just the direction. That's all we need for our purposes today. All right, up first, bond yields. We're looking at the yield on the 10-year US government bond here. The second the CPI data hit the tape on July 11th, the yield fell. Why did the bond yield fall? All right, let's look at it this way. Let's say you are considering an investment in this 10-year government bond, and you expect inflation to come in at a certain level over the next 10 years. And based on this expectation, you demand that the yield on this government bond be higher than that inflation expectation so that you will realize what is referred to as a real return, a return above inflation. Otherwise, you'd be losing purchasing power if you had a bond that yielded less than the inflation rate. Okay, well, with the softer than expected inflation print for June, your expectation for inflation over the next several years just went down. So you are now willing to accept a lower yield on this government bond, as are many other investors in government bonds. And that helps explain why the bond yield fell in response to the softer than expected inflation reading. Next up, we have the dollar. The dollar fell in value. Now, why would that be the case? Well, if interest rates have declined, like we saw in the previous example with the US government bond, then it's relatively less attractive for foreign investors to buy the dollar to invest in US securities like government bonds. So at the margins, international investors sell US dollars and invest elsewhere in the world. So lower demand for the US dollar because the yields of US dollar denominated securities have declined puts downward pressure on the value of the dollar. And finally, we have gold. The price of gold spiked higher on the news. And for this explanation, we can look at what happened to interest rates and the value of the dollar. First, interest rates. As interest rates fall, gold looks more attractive essentially because it has a lower opportunity cost. And what I mean by that is gold doesn't yield anything. It just sits there as a store of value, doesn't generate any income. So when interest rates are high and investors can earn good cash flow yields from bonds, then gold is relatively unattractive. Conversely, when interest rates are declining, holding gold looks a bit more attractive. And the other driver of the spike in gold is related to the falling value of the dollar we mentioned earlier. Gold is quoted in dollars. You can look at it as a currency. Just like it takes more devalued dollars to buy euros, it now takes nominally more devalued dollars to buy an ounce of gold, resulting in a higher quoted dollar price. And that is all for now. Please call me if you have any questions. Otherwise, I'll see you in a month.